Let's get some perspective now from one of our regular guests here, Kevin Page, who's the president of the Institute of Fiscal Studies and Democracy, but also the former parliamentary budget officer. Kevin, always great to see you. And obviously, you've been getting a lot of questions about this issue. What would you say? How likely is it that Canada could lose its AAA rating?
Well, John, there's always a risk. I wouldn't say in the short term that it's likely, but there is a risk. We saw, what you just said about Australia with a warning. I think we saw in the United States as well after the 2008 financial crisis, when they struggled with very high deficits relative to GDP and debt limits, that there was a warning and a credit rating adjustment. So there's a risk. I don't actually think it's a high risk at this point because Canada's in relatively good fiscal shape.
What would you point to when you say in good fiscal shape? I mean, some people will hear that and say, wait a second, we're spending left, right, and center, it feels like, to try to salvage some kind of road ahead for the economy. What is it that puts us in that better fiscal shape, do you think?
Yeah, a few factors, but first I'd probably start with saying that I totally understand concerns by citizens, some business commentators when they see enormous increases in deficits. That is obviously alarming. The Parliamentary Budget Office came up with some numbers recently saying the deficit could be in the $180 billion range. 8.5 percentage point of GDP. That's a very high deficit. But I think it's in the context of very unusual times. So what puts us in good fiscal shape is, that debt, the size of debt relative to income, that is, it's very low in Canada relative to other countries. I think the carrying cost of that debt, when we look at public debt interest charges relative to revenues, or public debt interest charges relative to the size of our economy, GDP, it's almost at record lows in my lifetime, notwithstanding the fact that we have increased the stock of debt since the 2008 financial crisis, and it's about to get a historic increase in 2020-21.
So that's helpful context, and it sounds like you think there would be a fairly long road to a situation where we're talking about Canada losing its AAA rating. Is that in part, I mean, how would you measure the moves by the federal government where we've already seen that spending? Could they have taken a different approach that would have potentially gotten us closer to, say, a deterioration of that credit rating sooner?
No, I mean, I think the credit rating agencies, certainly the big three, they look at these broader indicators of fiscal sustainability. So they look, they're very interested in looking at our fiscal structure and looking at how, with normal assumptions with respect to potential growth and demographics, are we fiscally sustainable over the long term? So these debt rating agencies, they're going to look at Canada's fiscal situation. They're going to ask themselves, okay, this big increase that we're going to see in the deficit this year, is it structural? And I think they're going to say, no, it's cyclical. And they'll look at the package of support for households, support for businesses, and liquidity. And I think they'll probably see that it's, that structure of that package is very similar to what's happening in other countries that also have AAA, ratings. And I think the size of the package, we might turn out to be a little bit on the large side relative to some other countries. But again, in the context of our low debt to GDP, I think the bond rating agencies are saying that Canada is doing what it did in 2008-9, which is really use its fiscal space to soften or flatten the recession curve.
Let's just go down sort of the road of, and I'll preface it by saying it seems like you don't think we're going to see the AAA credit rating change anytime soon. But if that were to happen, I mean, what does that, for those who are curious, what would that mean? How would that impact Canada?
Well, I think we've had this AAA rating for just really forever. One of the few countries who've never defaulted in the history of our country. So we're used to having this standard. So definitely when people from around the world or in Canada, they look at our government bonds, our treasury bills, they're definitely investment grade. So again, this is sort of sought after. We've seen a lot of foreigners very interested in Canada debt instruments, certainly since the 2008 financial crisis. So what would it mean? Actually, I think, well, first of all, it'll probably play we get a warning first from one of their, from the credit rating agencies if they were planning on it. Now, my guess is that the warning would be related to that they would want to make sure that this package is temporary, and they would want indicators from the government, when is it going to come off? And I think at the end of the day, for governments, it could mean a higher risk premium. That if we were to lose that AAA, if we were to get an adjustment, we could see an increases of a number of basis points in our interest rate on bonds or on bills. So I think, again, in the context of these record low interest rates, where we've not seen these yields and again, in my lifetime, for 10-year government bonds or 3-month Treasury bills, like below a percentage point, well below a percentage point. So I think an increase in it'd be an increase in basis points. And again, it would be a little bit worrying because there is a lot of debt. Certainly federally, we are adding to that stock of debt. So like to maintain the AAA rating is important. The government highlighted that actually in its 2019 federal election campaign as one of its pillars for fiscal strategy. So, we're going to work hard to keep that rating, and there'll be more work to do after we get through this pandemic.
Kevin, we only have about 30 seconds left, but at this point, what do you think is I mean, there's so many risks, but sort of the additional risk to watch, because we're watching to see what happens with the health crisis, but some wondering if that leads us to sort of a staggered return to normal. Does that mean double dip recessions? Does that mean even further spending by the federal government in the face of this uncertainty? Yeah,
I think well, you're right. The health risk is the number one risk. As we read news clippings from around the world, we're seeing some progress in the flattening of these epi curves. So this is really good news. We know that we're still months and months away from a vaccine, so that the possibility of these waves are likely. There's already talk of industries like construction and other coming on back sooner rather than later. I think beyond the health risk, though, I think it's energy prices. And though there's some good news with respect to some production cutbacks that could put a floor, I think, under these oil prices. There's a lot of adjustment that's going to impact Canada with respect to the energy sector. So watching that play out and watching how the federal government supports that sector will be important.
All right, we'll keep an eye on that for sure. Kevin, thanks as always. Good to get your perspective. That's Kevin Page, president of the Institute of Fiscal Studies and Democracy, with his take on Canada's credit rating.